Even if you fear it, can you profit from it? And my thesis is, yes, we should be. We should be able to create real wealth from taking advantage of some of these really fantastic opportunities. There is risk, but there is enormous upside. And I'm pretty happy to see a lot of this stuff correct in recent weeks, because this is a long-term story, and the cheaper you can buy this stuff, or the lower in price you can buy this stuff, the more upside you're going to have. And I think that remains the case. But overall, I think it's temporary, because the view that I've got is interest rates aren't going up. So a lot of people say, well, if interest rates go up, then that's going to stop these growth names because they act like zero coupon bonds. Sort of. I think that realistically, interest rates, even if inflation runs hotter, underlying inflation over time, as opposed to the year-on-year base effects of what happened last year, even if they run hotter, the Fed won't allow rates to go up. It's kind of financial repression, but that means that these names have to go up. And heaven forbid they really sell off, or growth slows, which I think it will in the second half, as people start looking forward to the fiscal cliff coming off and a number of other issues. Well, and also the rise in prices of commodities, fuel and stuff like this, that slows down consumption somewhat. So I think we will see a slowdown as well coming later at the end of this year and into next year. And that probably allows the Fed or the government to apply more stimulus. And that's normally the pattern that comes out of recessions. They're not done at the end of the recession, because normally there's a slowdown at the end of the fiscal, and they start having to do something again to keep the economy balanced because they don't want it to stop. I think we're going to see that 2 or 3 rounds, much like we saw last time, 2 or 3 rounds of it. So in that scenario, it's very difficult for equities to stop going up and these kind of names not to benefit greatly if the Fed keep expanding their balance sheet. As we've talked about, the Fed and the central banks are expanding their balance sheets by about 15% a year. I mean, this is true. So we tend to create boom bust cycles within this, and that's pretty normal. We see it within Bitcoin, we've seen it within Amazon, we've seen it within all of these things. Excess enthusiasm, then no, I'm all wrong, and they're called S-curves generally. And that's very normal for this space. You see it in startups, you see it in building real vision now. We go through these moments of euphoria, like we've cracked it, and then we're like, we're idiots, and it's all terrible, and then this is amazing. That is the life cycle of these things, particularly when you're trying to build network adoption models. So the way to look at it over time is, what is the growth of their network? Is their network adoption within that? I tweeted something about this yesterday. That whole space is going to go from 126 million users. It's growing at 113% a year in terms of number of users. It will get to, even if it slows to the rate that the internet grew at in its first 10 years, and that was 63% a year. So this is the fastest growing adoption of any technology in all recorded history. If this continues to grow just at the rate the internet did, we get to 1 billion users by 2024. That's quite fast. And that'll be the fastest adoption of any technology to 1 billion people in all recorded history. And then we throw in stuff like Facebook DM and stuff like that. We talked about this in our interview. These things are incredible. So how do you participate in that? Well, at a simple level, Bitcoin will work. And you will have an up and down cycle. Like you said, there'll be excess enthusiasm, then this is not going to happen. And then, oh my God, this is all happening. And that's how it works. If you look at all exponential trends, they do this and then this. The idea is you've got to be early in that stage and then ready when it goes. So always at this phase, you don't see the exponentiality, and it's always racked with fear and doubt. But we know that it's going to get there because it's driven by mandate and money. So the probability of it going exponential in the technological adoption of these things is huge. Einstein said the second most powerful law in nature is compounding, and this is compounding on steroids. We're not compounding 10% interest, 5% interest. We're compounding 100% growth rates. I mean, the crypto space is growing at 113% a year. So that gets us to 2030 at 5 billion people. I mean, get your heads around that. 125 million to 5 billion people in a decade. I mean, wow. My current allocation, because I know everybody asks, I'm now currently about 25% Bitcoin, 55% Ethereum, and 20% other tokens. Why is Ethereum my bigger bet right now at this point in the cycle? It's because it is seeing different network effects. So it's got the network effect of investors, so people piling in. There's the network effect of developers working on the space, which dwarfs any of the other spaces in crypto. And then there's the network effect of the applications being built on, like DeFi and NFTs. So you've got this holy trinity of things happening. And then on top of it, you've got this change to ETH 2.0, which basically massively reduces the supply because they're burning ETH. So what happens is it becomes a scarcer asset. So then you've got a super scarce asset that is in massive demand from investors, from applications, and from developers. The other problem with ETH has been the high fees, and that remains the thing, the gas fees. But within the part of the transition to ETH 2.0 is this move to proof of stake, and how this may lower the gas fees significantly and free up the network. And people are then building layer 2 solutions across it to make sure that we can get around this. So all I see is this giant sucking sound of talent into the Ethereum space right now. That means that it is growing faster, and it's playing out in the price of Ethereum versus Bitcoin. And also now with the FUD narrative, that is one of the things I believe the ECB started, was this, well, it's not green, look at the mining costs. If we looked at everybody's kettle use across the world, it's probably more than that of the whole of the electricity of Norway. I mean, people just, it's because they've sliced it this way that it makes it look bad. I think it's the ECB trying to slow institutional adoption by pushing the ESG mandate back at these people, saying, hey, you've got a mandate here, and this doesn't fit into your mandate very well. And that slows adoption. I get why they're doing it. Problem is that creeps into Ethereum, which has a much lower energy input. So it just creeps out of one space and into another. You're not stopping the rise of digital assets. You're just slowing down Bitcoin at this phase. It'll speed up again at some point too, probably particularly when the ETF launches. But the economic slowdown plus a extended decline in markets is now currently near impossible, which is bizarre. But that's what it taught us with the biggest recession in all recorded history, and it went down for a month because what happened is this change in denominator value.